Should you use an endowment plan to grow your savings for a future goal? Or would starting a fixed deposit account, high yield savings account, or maybe even doing direct investments be better? Let's find out. My name is Sean.
And my name is Jasmine.
Today we are going to figure out if endowment plans are a good vehicle to help you save.
So the different types of endowment plans. Endowment plans can be short-term or medium to long-term. Short-term endowment plans are also known as single premium plans that have a short lock-in period of 1 to 3 years and include guaranteed returns upon maturity. Medium or long-term plans have annual premiums paid over a longer period of 2 to 10 years and saved for 6 to 20 years. Unlike a non-participating plan, which has guaranteed returns and likely no share of any profits that the insurance company makes, medium or long-term endowment plans are participating plans that are entitled to profits of the insurance company's par fund. These plans often provide both guaranteed and non-guaranteed benefits.
Non-guaranteed benefits may include bonuses and cash dividends and are dependent on the participating fund's investment performance, number of claims made on the fund, and expenses incurred by the participating fund. Hence, this can potentially enhance your maturity payout in good years. However, these plans have a bit more risk because in difficult years like 2022, where global markets fared poorly, the non-guaranteed benefits received by policyholders would be lesser or perhaps even none at all. You can learn more about your insurance company's participating fund's performance through the illustrated rates of return shown in your policy document.
Pros of endowment plans. Capital guarantee. Endowment plans can be a capital guarantee method of saving money for a mid to longer term goal where you will not get back less than what you have deposited, provided you did not make any premature withdrawals or policy termination. Most importantly, it is an enforced financial discipline. The premature withdrawal and termination penalty fees encourage financial discipline. If you are someone who has a habit of tapping into and spending your savings, this can be a good way to prevent that and cultivate the habit of saving.
Attractive interest rates. Although the interest rates differ between insurance companies, there are endowment plans that can offer up to 5% per annum guaranteed and non-guaranteed returns, which can help grow your savings even further. Premium waiver riders. Endowment plans often come with the option to add on a premium waiver rider. This is a rider that waives the remaining unpaid premiums while allowing the plan to stay in force. Should something unfortunate happen to the policy owner that deems them unable to keep up with the premium payments. Some plans even integrate this benefit in the main plan instead of as a rider.
Cons of endowment plans. Firstly, illiquid savings. If you surrender or terminate your plans prematurely, you will only get back the surrender value indicated, which is often lesser than what you have paid. This makes the plan less flexible compared to other plans such as a high-yield savings account. Short-term endowment plans can feel a bit like a hassle due to its shorter lock-in period. Although some may prefer the shorter lock-in period as they can get their returns faster, it can be a hassle to keep finding the next place to shift your funds into, especially when you are unsure of what interest rates and premiums would be thereafter.
Large minimum deposit. Most short-term single premium plans require a substantial minimum deposit of at least $10,000. This makes it less suitable for those who do not have much savings to begin with and are looking for plans to grow their savings. If that's the case, what are the other capital guaranteed options then? High-yield savings accounts. High-yield savings accounts are an easy and accessible way to help you grow your savings. You can open a high-yield savings account with any local bank and deposit a portion of your income regularly in the account to save. The advantage of high-yield savings accounts is its high liquidity that allows you to withdraw your savings anytime. Furthermore, unlike the high minimum deposit in an endowment plan, a high-yield savings account usually only requires $1,000 deposit, depending on the minimum fall below sum of each bank account. If you do not have enough savings to start an endowment plan, this can be an alternative method to grow your savings.
However, the disadvantage is that if you are not financially disciplined, this could be your downfall, as you may spend your savings prematurely. Furthermore, if you wish to receive a higher bonus interest, you would have to fulfill certain specific requirements like depositing your salary and achieving minimal spending on eligible credit cards. If you do not meet these criteria, your interest rate is likely to remain closer to 1 to 2% per annum.
The next method is fixed deposit. If you already have a substantial amount of savings and you want a higher interest rate but find it a struggle to meet the various monthly banking criteria of high-yield savings account, you can opt to save via fixed deposits. These deposits have a fixed interest rate on your savings which are also locked with the bank for a fixed duration. This method may be more suitable for those who are less financially disciplined, as the fixed deposit savings are less liquid, as your savings will be locked with the bank and can only be withdrawn if you pay the penalty fee. The fixed interest rate can also provide some reassurance during global market instability. The disadvantage is that fixed deposits usually have much larger minimum deposit sums of at least $10,000 or more. Hence, similar to endowment plans, if you do not have much savings to begin with and wish to build savings to change that, then fixed deposits are likely not suitable for you.
Other saving options include direct investments. If you are financially savvy and know how to invest, you can consider investing directly in markets to achieve your financial goals. Of course, this would likely carry more risks compared to the previous methods mentioned, so ensure that you understand investments well enough if you wish to consider this option. Direct investments may be a better way to reach your savings goals, as there are various different ways you can directly invest in the market, such as unit trusts, ETFs or exchange traded funds, stocks and bonds, low-cost ETFs. Essentially, direct investments is a more risky way of growing your investments. You have to be skillful in knowing when the best time is to liquidate your investment and be prepared for the possible loss. It may be wiser to build your savings foundations through capital guaranteed tools while learning to invest properly for greater potential returns.
In conclusion, endowment plans can be a good way to save money for future goals, provided you have sufficient savings at the beginning to embark on one and do not liquidate your savings prematurely. Endowment plans can even be tools to enforce financial discipline on top of growing your savings. To fully determine if endowment plans are the way to go for you, evaluate your personal circumstances, financial goals, risk appetite, and expectations of returns. Endowment plans can be a safer option as they usually offer capital guarantee, but the returns will likely be lower than those from riskier money growing methods like direct investment. You would have to personally decide if you wish to prioritize the level of returns you receive or even capital guarantee. My name is Sean,
And I'm Jasmine.
and we hope this video was helpful for you in some way. See you in the next one.